Good morning. This is Barry Knapp with Ironsides Macroeconomics. 7:20 a.m. Mountain Time on Monday morning, October 6th. The government remains shut down, so we did not get the employment report last Friday. This week's note doesn't cover it. Importantly, this week's note is outside the client paywall, and I would urge all of you to have a look at it. It is a very dense note, complete with one of the things that we think we do well here at Ironsides Macroeconomics, which is micro to macro analysis. I was, after all, the head of equity strategy at Barclays for 6 years, Barclays Capital, that is, and had a little bit of a different background, having been in derivatives and having moved on after that into fixed income portfolio management and ability to look at the equity market and see what it's telling you about the macro environment and the macro environment and what it's telling you about the equity market, as well as obviously the fixed income market and other asset classes. So we began with a discussion of correlation, which is one of the biggest risks in the equity market. We're at record low levels of correlation. And we explain how the policy, monetary and fiscal policy, in the aftermath of the global financial crisis, where there were support programs for virtually every kind of fixed income asset, created a super highly correlated environment for the equity market. But how the Fed's unbalanced policy in the current environment has created record low levels of correlation. And so if there were to be a rate shock, which is an issue we discuss in this week's note, in probably in early 2026, how that could create a spike in correlation and a very intense or acute risk-off environment. And so it's an interesting concept. We'd urge you all to have a look at the note and think about that a little bit. We then went on to talk about the labor market data we did get and how the Fed has this curious approach to talking about the labor market as if they somehow will impact businesses' willingness to hire or not hire people. Nonetheless, we think the labor market is decidedly weak, and the Fed really should have gone 50. Before I move on to some of the other concepts in the note, I want to make a point that we made in the beginning of the note, which is really all the Fed needs to know and policymakers need to know in terms of the net impact of the policy mosaic, that is lower government spending, higher tariffs, tax cuts, really corporate tax incentives, lower immigration. This whole policy mosaic can be distilled down into the performance of the fixed income market. 2-year Treasury note yields are down 68 basis points year to date. 10s are down 46, and expected inflation break-evens are unchanged. So this is not creating an inflationary impulse. It is weakening growth for now, at least. May very well get us to a better place later on. We'll leave that aside right now. But the net policy mosaic is lower growth, lower bond yields, and no increase in market implied inflation. The Fed should have gone 50. So moving on to the rest of the note, we talk about the differences between the Big Beautiful Bill Act, the Tax Cuts and Jobs Act, the impact on buybacks and capex. The Tax Cuts and Jobs Act really boosted buybacks. This one is boosting capex, but it's still very concentrated. We go on to a discussion of the regional Fed surveys and the ISM manufacturing and services surveys. Those were both weak. Orders were weak for all of them. Employment was weak for all of them. We don't get capex from the ISM surveys. We do get it from the regional Fed surveys. It's been falling since the Big Beautiful Bill Act was passed. This is, again, the broader policy mosaic. But another important point of difference here is ISM reports prices paid, not prices received. The regional Fed surveys gives you prices received. That is falling. Prices paid are still firm. This shows you there is no ability to pass prices through, hence no change in inflation break-evens. The environment does not exist to create inflation, as was the case in 2021. We then move on to some more micro to macro stuff, looking at profit margins of the various sectors and how we would expect, or what is expected for earnings, is that the consumer-facing sectors are going to see significant margin pressures, negative year-on-year earnings growth, weaker revenue growth, but really seeing downward pressure on earnings because of profit margins and an inability to pass tariffs through to the final consumer. We then move on to a pretty good discussion about capex as a percent of cash flow and how comparing it to the energy sector in the mid 2010s, tech in the late 90s. And one important point here is that in the late 90s, we had gone through an economy-wide, very, very strong capex cycle. In fact, the strongest boom in real capex spending that we've seen since World War II. That's very different than the current environment where the 2010s was the second weakest capex cycle since World War II. And it's been weak in the early part of the 2020s as well. So we don't have the broad conditions for a bust in AI spending to turn into a broader systemic recession-inducing event. But there are lots of similarities, and we'll be talking more about that and looking at the benchmarks. We then move on to a fixed income supply argument. I'm going to leave the rest for you to have a look at the note. Even if you're picking this up on YouTube, go to ironsidesmacro.substack.com and read the note this week and see what you're missing by not being a paid subscriber. This is Barry Knapp from Ironsides. Have a good week, everyone. Thank you.